I know what you mean. I do have that happen sometimes. I get it. Sometimes it's a fine line between being respectful and kind and, hey, I've actually got another commitment, but it all works out most of the time, right?
Yeah.
So y'all ready to get started?
Yeah.
Super. Any questions? Any questions before we get rolling?
Nope.
No question.
So, typically the idea of finances, it's not quite up there with going to the dentist, but, let's be honest. What's your level of excitement about demystifying business financials? This is the honesty portion.
I have no problem going to the dentist. I go to the dentist regularly. I don't, even when I have to have work done, it's something I do, and I'm just because I got to get it done. But this is something that you put a spreadsheet in front of me, you put details in front of me, and I'm usually going to gloss over unless somebody can make it somewhat interesting.
You mean like this?
Yeah, I saw the spreadsheet being dragged over there.
Yeah,
but it's one of those things where I'm really good at math. Like, I mean, I think I'm a fairly intelligent person, and I did well in school in all things except accounting, any kind of accounting classes, and economics. It just was beyond my ability to understand, it's unique because I usually feel like I can understand just about anything.
Might be you, might be the teacher, who knows?
Could be.
And sometimes we're what's it say when the student is ready, the teacher will appear, or maybe another way of putting it is when we're ready, the information sometimes is a little bit easier to understand because it's real. Okay, I've got a business now, or I'm about to launch a business. This is real. And we tend to pay a little bit more attention, or maybe dig a little deeper or ask better questions because it's real. So what about you, Adrian? What's your background with business finances, financials, and things like that?
None.
None? Awesome. This is fantastic. Seriously, it really is.
Get into it just so that I can learn. This is where I'm actually struggling the most. And this is where I need the most help with starting my business.
Oh, that's fantastic. Good. So what I'd like you to do as we go through is I want you to take a note of any thoughts that come to mind of things that we didn't cover that you'd like, that you wish that we would have, or that you wish that we would have and probably need to. And if it's not something that's really big, we'll go ahead and take care of it here at the end today. If it's something bigger, there's a couple of things I could do. We can think about an off session, or it depends on the level of your challenge, right? So we'll figure out at least a next step for you if there's anything that we don't really get into today that you need more help with.
Okay.
Make sense?
Yep.
So Paul probably knows this. Rochelle's background is actually accounting. So I asked her not to attend because I was afraid she would embarrass me. That's actually not true. Her background is accounting. This isn't something that I didn't know if she's going to join us today or not, because this is something that she knows a lot about. So she may join us in a little bit, but if she jumps on board, maybe we'll have some fun with her. But anyway, let's go ahead and get started then. So business financials. Let me adjust my Zoom here. There we go. All right. So these are a few of the things that we want to touch on today. Income statements. And I want to make them real simple for you. This isn't a test or memorization. Talk about the difference between profit and cash flow, forecasting and budgets. And I'm not going to get into the details of this is how you build a budget. I want to let you know how simple it is and what a budget looks like and how easy it is to actually get one. People overcomplicate these things, especially you can learn about all these things at a big business level. But if you don't figure out how to simplify it for a small business, it can be overwhelming and it can be a waste of time in a lot of areas. Because, when I was new in my coaching career about 15 years ago, I had worked for a company that was a couple $1 billion a year and growing fast. And I had my first client and I was working with him and he was really excited and he wanted me to put together this plan that he and I worked on. And I put together this plan, I don't know, it was like 4 pages, 5 pages long. He's like, man, this is really great, Mike. He said, if I was General Motors. And he and I had a pretty good rapport by that point in time, but his point was really clear. And I learned a lot working with him over a 3-year period while he was doubling his business. And that is, big company ideas are great, but you have to make them small company digestible, or else it's just overkill. It can be a distraction. And I think there is a real deficit of what I call stage appropriate information for small businesses out there. So we're gonna dig into that a little bit. We'll talk a little bit about break-even point, just the simple parts that you need to know, and we won't get into too many complex mathematics. I've got a really easy formula for you that I think you'll like. We'll talk about the balance sheet and why it's important. We're not going to get into the boring details of it, but why does it matter and what do you need to look for on a balance sheet? Where do you find it? And then there's some freebies. And if something doesn't make sense, unless you've got noise in the background, you can leave yourself off mute. But if something doesn't make sense, just say, hey, I don't get it. And we can spend a little more time, or if it's a more deep, I don't get it, then we'll figure out a plan B. Sound good?
Sounds good.
All right, let's roll. So I'm going to make one small adjustment here. All right. Pardon me. I got to make an adjustment here real quick on my my Zoom view. Well, it's not going to let me do that, so I'll roll. Okay, again, so this probably looks real familiar to y'all by now, the 6 steps. And what I like to do each time we talk is kind of put into perspective what we're talking about now and where it fits into this. Because, hi, Teresa. Did y'all talk? Did you do this on purpose? This is hilarious. Paul, I feel left out.
I love them. I love them, by the way. The hats are amazing.
Awesome. Yeah, isn't that awesome? Sorry, I'm getting a pop-up here on my screen. Do you guys see that, by the way?
Yes.
Game Force ready
the GeoForce thing.
Yeah, I have no idea why that's popping up right now. Hopefully I didn't just enable it, but I think I did. So if I did, I will pop that off. Okay, good. All right, so as we talk about the 6 steps, one of the things I like to do is I like to continue to put things in perspective and help you understand how kind of all roads really come back to this. Okay, it is going to do this now. So let me exit this. There we go. So what we've worked on now, what we've worked on so far are the green areas, which is destination. We talked about that. We talked about time. We talked about service and delivery last time. We've talked about 5 ways: growth, marketing, customer retention. And then this money piece, this financial piece is what we're going to talk about today. So as you can see here, this isn't uncommon with businesses at all. But so much of what we focus on is really on that foundational level, right? We got to get the right direction. Got to have a clear idea of what our goals and priorities are, some idea of what our longer term vision is, our values, where we want to go, some idea of how we're going to manage and manage our time to implement our plan, how we're going to service our customers. And then we've got this other stuff as we grow that becomes more important: leverage, systems, processes, teams, etc. So, you know, I just like to bring everything back to the basics. There's 4 fundamentals at that mastery level, and today is going to be about financial and money. The first thing I want to do, you know, I kind of asked this question already, and I think Adrian and Paul answered that they're not a 9 or higher with business financials. How about you, Teresa? Have you got any background with business financials or accounting or anything like that? I think you might be on. You don't look like you're on mute, but maybe your microphone might be turned off. Can't hear you yet. Let me send you an invite to unmute. Hold on one second. going to mute you and then ask you to unmute. Can you unmute now? No, I think you might still have a challenge with your microphone. Sometimes it's just a setting. If you go over to your bar where it says there's a little mute button there, if you hover over that little chevron, that little arrow down, and it'll say select speaker. And sometimes you can just select a different speaker option, same as system or something like that. Sometimes that does it. Sometimes if you've got like I think I might have heard you there.
That was me. But yeah, select a microphone is the one she wants to.
I'm sorry, you're right. Yeah, select a microphone. So
there's also an option to test speaker and microphone.
Yep. Thank you. Thanks, Paul.
Do you see that, Teresa? Okay.
Yep. So just select a microphone. Sometimes if you've had a wireless or Bluetooth device hooked up, it can get in the way a little bit. So if you get that role, and let us know. I'm going to go ahead and
use the chat.
Or use the chat. There you go. This guy's a pro. He does these things every week. So I'll defer to Paul on some of this. All right. All right. So I don't think we have any accountants in the room. I think we answered the first part. One thing I do want to talk about, and there's a tip checklist that I'll hit here in a few, but it's anybody here have books yet to where you have numbers coming in? Anybody at that point yet? Okay, when you do, make sure you get an accountant. I know that it's tempting to save the money, but if you don't have resources, I have resources for $100 once a quarter, you can probably at least get them to look over your stuff. If you're in a coaching relationship with me, I'll do it. I do it for free. But I just want to highlight the importance of that, because you've heard the saying, especially in IT or computer communities, garbage in, garbage out. It's exactly how it is with financials. And I can't tell you how many times that I've tried to help a company, but their financials are such a mess that it's like spaghetti soup, and it's hard for me to help them. So if you don't have QuickBooks or Xero or something like that, you want to start with a real accounting program. Doing it in Excel isn't going to work for very long for most businesses. Those other tools are really inexpensive nowadays. You can get a monthly subscription for, I don't know, it's probably 10, 15, 20 bucks a month. And it's just worth doing. And the good thing about it is if you don't choose the one that you want to get married to, you can always export it to Excel anyway. So just a little bit of a plug. If you don't have an accounting software system, don't wait too long to get one. Like I said, QuickBooks is a good option. Xero is another option. There's another one, what's it called? Wave, W-A-V-E. It's actually free. It's pretty good. The way that these free services make their money is they hope that you'll attach credit card options to the software. And when you bill your customers, if they pay you with credit card, they collect credit card fees. So they get paid plenty of money, trust me. But don't, in this day and age especially, I wouldn't wait too long to get an accounting program or software. Make sense?
Okay.
All right. These are just some financial tips. And, feel free to jump in or provide feedback. Bookkeepers are not always accountants. Many are self-taught, and many people fancy themselves to be bookkeepers. Mothers, brothers, cousins, best friends, cousin. That's the type of stuff that gets people in trouble. If you're going to be the person keeping your books, take an online course or enroll in the tutorials that come with QuickBooks or Xero or these other programs. YouTube is an endless resource for mostly good information. So you got to qualify people. Make sure that, like I said, you do have a qualified CPA or accounting professional to help you here and there. The money that you'll invest is far less than the mistakes that you'll make. And make sure that somebody is providing you with good tax coaching, tax consulting. We have a great resource in our group. They'll usually do one-off coaching and consulting on tax things, and taxation is where a lot of small businesses get in trouble. Probably the two most common is they don't pay their taxes on time because they don't know what their taxes are, they don't know what the forms are, or they don't do payroll taxes right. If you have people, get a payroll service. Don't mess around with it. It's 25, 30 bucks a month. There's online options. Don't try to do it on your own because the fees and the penalties will far exceed the cost of doing it right. Same thing with tax advice. Missing out on the right tax information and how to report your income on a quarterly basis. Once you start making money, especially in that second year, you're now responsible for quarterly taxes. First year, not so much, but you will be responsible at the end of the year for the taxes that you should have paid when you should have paid them. So for instance, if you make a big profit Q1 and you don't pay your taxes until the end of the year, it's not like personal income. You can find yourself in a position where you're paying penalties. So just keep that in mind. If your business is making a profit in its first year, you may have some tax liability that you got to pay before the first year, and penalties accrue from whatever time period the taxes were due. So again, that's a situation where it's better to pay a professional to give you advice than to pay the government to tell you that you did it wrong. Also, too many owners of businesses limit their ability to make good decisions because they don't have good tax information or good financial information. Often they'll instead of asking, can I afford to make this investment, or what is my ROI? They just ask themselves, do I have the money? Do I have money in my account right now? And they don't prioritize those decisions. So, you've really got to, especially when you're a small business and you have very limited funds, and oftentimes you're running a negative that's costing you money to be in business to serve people, right? You really have to prioritize those financial decisions, and having good or accurate financials is really important to making that happen. This is in one of the don't do's or business killers in a minute, but I'll hit it now. One of the biggest mistakes that business owners make early on, there's two that come to mind, is they don't invest in smart, inexpensive, affordable marketing soon enough, and then their cash starts to run out. Their business isn't growing at the rate that it needs to, but now they don't have the cash to invest in growing their business, and they get really squeezed. And they get in this mindset, well, oh my gosh, I don't have enough money, but I need to grow, and they're gripped by panic or fear or hesitancy. The other thing that happens is just the opposite. They've got money set aside for the launch of their business, either credit or cash from a job or something, or retirement or something that they left, and everything's good right now. So sure, I'll invest $5,000 in radio advertising. Newsflash, for most companies, radio advertising for a new company is a complete waste of money. It isn't that radio advertising is a bad thing. It's a great thing at the right stage for a business. But most radio advertising, take me literally, is about branding. When you are a new business, your number one goal as a business owner is to get to break-even point so that you can relieve the stress and make clear decisions. And when people invest huge chunks of money into things that have a long ROI, radio advertising can have a tremendous ROI. But do you have a year? Do you have a year and a half? And again, radio people will shoot me in the foot on this, and maybe I shot myself in the foot on this. There are exceptions, but I've just seen a lot of people invest money in radio and even booklet magazines or TV too soon, when they should have really invested their funds in other types of shorter term marketing, and their business runs out of cash and they have to close the doors. Now, none of those were clients of mine. These are just horror stories that I see or hear. I don't let my clients do that. So anyway, it's a little bit of a divergence, but we just moved ahead a couple of slides. So if we want to understand our financials, next to last bullet point, or we need to use them, we need to understand them. We need to know the numbers that really track our business and drive our business. So business killers, this is just a list you can go through more. Business owners don't know their number, they overcommit, fixed expenses. Fixed expenses, if there was a third thing that I see that kills a new business, is they overcommit to overhead that they don't need. Maybe this was more the case 9 months ago when everybody felt they needed an office to be legitimate. I'd see business owners go out and get a nice swanky new office or a nice new big red truck or a $7,000 website. Those are all wastes of money for most businesses, based on my experience as a business coach and a business owner. They're not wastes of money per se, but they can be huge wastes of money for the stage of business that you're at. So other business killers, comp plans aren't tied to sales. We bring on a new employee, we love them, they're doing great. I'm going to put them on salary. Bad idea 9 times out of 10. Keep a little mystery in the relationship. Be fair. Make it a good base comp so they don't feel like they got to go get another job. But make it hourly and then based on performance. And it doesn't have to be dollars brought in. It can be specific performance objectives. But that's a business killer. Another one is the owner doesn't focus enough time generating new revenue. Reminder, our number one job as a business owner, and at least until we reach break-even point, is we're salespeople. We are salespeople first who just happen to have this industry that we're in. But don't forget that as a business owner, our number one job, it isn't marketing, it's selling, it's getting new clients, and then it's taking care of clients so that we can get great testimonials, referrals, and build a great business. But don't ever forget that. I talked about this one before, hope it works marketing, even SEO or pay-per-click. And this is in Paul's world. If it's not the right time, that can be a mistake. There's a lot of other things that you can do. And Paul's a great resource to talk to about that, to make sure that you do the right things in the right order. Very, very important for businesses. ROI mindset, I touched on that. $3,000 radio ads. Lack of ongoing marketing to past and current clients. You know, a great marketing strategy is, who knows you? And have you reached out to them just to let them know what you're doing now? And it's as simple as this. Hey, Joe, it's been a while since I talked with you. I don't know if you realize this, but I've recently gotten into the X business. We've known each other for a number of years. I was wondering if you'd do me a favor. I'd just like to share kind of what I'm doing in my business and get your input on what you think about my business, my direction. And, you know, and again, I just want to have one more person out there who knows what I do. Would you be open to sitting down with me and just providing me with some feedback? Well, while that's happening, that's one more person who knows about your product and service. And then at the end, you can always ask them, who else do you think needs to hear this message? So, you know, everybody on this call probably has a network of 50 or 100 or maybe even 500 people. And imagine if you were to do that with everyone in your database. And if they're a friend or someone who you've met professionally, you're probably going to do it. And you're not selling anything, okay? Another business killer, we sell too many products that lose money because we don't track the ROI. We don't reach our target market. We run out of cash credit. I talked about that. They wait too long to hire people. Their service suffers, and then they lose customers. Or they discount, which is a way of training customers to wait for discounts in some cases. And discounting is near and dear to my heart. This is what happens to your profit. A 10% discount on your prices. If you have a 40% gross margin, which means after you pay for the basic labor or product, a 25% reduction in profit. So think about that. 10% doesn't seem like much until you just think about, well, I just gave away a quarter of my paycheck. So, and sometimes it's more than that because I use gross margin. If you talk about your actual profit margin, the percentage you're giving away could be even bigger. So just keep that in mind. A 10% discount has a 25% reduction. A 10% increase goes the other way. So just think about that. Okay, so now we're going to get at some terminology. I'm not going to go super deep on these things, but I want y'all to at least have some basic understanding. And if there's any questions on this, you know, just let me know. I've heard this thrown around a lot, what's cash-based accounting and what's accrual-based accounting? Has anybody heard those terms before? Cash-based, accrual-based. So here's why it's important. Cash-based accounting is real simple. That is a method of tracking expenses and income based on when money changed hands. So if you walk into a store and you buy a product and you're on cash-based accounting, your sale occurred for that business on that day. If you're in a service type industry though, possibly, and you're on accrual-based accounting and you did the service this month, but you send the invoice next month, then that's accrual-based accounting. So on accrual-based accounting, income and expenses are counted at the time that the invoice actually takes place. If it's cash-based accounted, it's based on when the money actually changes hands. So if they don't pay that invoice until the next month, and in example number 2, then everything accrual-based happened in that next month. Does that make sense? I try to really boil this down. Cash-based accounting is just when physical money changed hands. Accrual-based accounting is more based on when the transaction was recorded on the books. Does that make sense?
Is it? I would imagine that some businesses are doing both at the same time.
Great question. Yeah. Yes, they are. Is there a question with that?
I wanted to make sure I understood it. That
Yep.
so like if you've got like well, let's say appliance repair, right? That's the business that I'm looking at starting. Is
Yep.
you can have your customers that are the pay as you go type that call you up. I need to have my dishwasher fixed or whatever, and then you have people like property managers who maybe have taking care of 2 or 3 of their properties, and then you bill them
Right.
when you're done with it, and that would be
That's
the
exactly
accrual.
right.
Yeah.
I'm really glad you brought that example up, Paul, because that's a really good one. And down at the bottom, you'll see the note that cash-based accounting is the most common, but it makes sense to run your reports both ways just because they tell you different things. And let me give you an example. So what does it mean to run your report both ways? Well, in most accounting systems, the ones that I mentioned, Wave, QuickBooks, or Xero, when you run an income statement, it'll give you the option on whether you want to run it based on cash basis or whether you want to run the report based on an accrual basis. So a cash basis is going to tell you what's happening to your cash this month. So if you bought $10,000 worth of inventory this month and only collected $8,000 of cash, you lost $2,000. Run that same report in accrual-based accounting, and it'll show that you might have purchased $10,000 worth of inventory, but then you might have billed that customer 12 grand for next month. And accrual-based accounting will look out into the future and see that that revenue is coming and that you invoiced them this month, and it'll show you making a profit. So the cash tells you what's going to happen to your cash. You're going to run out of money this month, possibly, and have to dip into savings. Accrual lets you know kind of big picture, am I covering my expenses? So yeah, I had a big expense this month, but how's it going to affect me overall? And it's more of an accounting conversation to have with your bookkeeper or accountant, or if I'm coaching you on a monthly or a couple times a month. This is the type of stuff that I do with all of my customers one-on-one.
When you're talking about, because one of the things I hear a lot about is cash flow.
Uh-huh.
So when you're talking about cash flow, is that related to cash-based accounting, or is that just a matter of cash coming in? If the question makes sense.
That's a great question. Cash flow is not inherently related to cash-based accounting. And I'll cover that when we get into cash flow. Cash flow is it's another term.
Yep.
So we'll talk about that a little bit further down the line. If I don't answer your question then, though, please bring it back up. Okay, so who here has heard of margin versus profit? Everybody heard margin and profit? So profit and margin are basically the same thing, okay? But they are not the same as markup. Okay, and I've got another slide where we'll talk about margin. Margin is just the difference between what you spent and the sales that you brought in. Okay, so if your total expenses were, if your total income was $10 and you had $9 in expenses, you're making $1, right? And in that case, that's a 10% profit margin. You can add zeros to that, still the same. If you have $100,000 of revenue and $90,000 of expenses, you have $10,000 in profit and therefore a 10% profit margin. So, you know, an example would look like this. So if you buy, if you buy products, if your total cost of products and service or what have you is $100, you sell it for $200, then your profit margin is $100. Well, in that case, that's a 50% profit margin, right? Does it make sense? Take a minute, look at it. If it doesn't make sense, we can explain it. But it just, it's so easy to overcomplicate this stuff. And I like to just boil it down to exact numbers. If you spent $100 between service and product, you sold it for $200, you made $100 more than you spent. That's a 50% margin, but it would be 100% markup. You see the difference there? And I'll show markup in a minute. Because our markup is based on your cost. Margin is based on your sales. Does that make sense? So margin is always a percentage of your sales number, which is the top number. Markup is you're going to your expense. And what did I mark my product up over my expense? And not knowing the difference between these two is why a lot of service-based businesses lose money, because a guy will be in the remodeling business or in the retail business, and he'll spend $100 on product, and he'll say, I want to make a 10% profit after everything's said and done. So he just multiplies $100 times 1.1, which gives him a markup of 10%. I'll give you the example here. So in this case, let's use this example. So you buy your product for $100. And let's say that we're the only person working in the business, so there's no labor associated, just ours. And I mark it up 50% on 100. That means I'm selling it for 150, right? Well, that's a 50% markup and a $50 profit. Okay? So the problem with this is it's not a 50% profit, because $50 divided by 150 is 30%.
33, yeah.
33, yeah. So if you think about that, you might think that you're making a profit, which is actually markup of 50%, when your real profit's closer to 30%. So a lot of business owners get themselves in trouble. And the same thing happens if you do a 10% markup. You know, your profit's probably going to be 7% or 6% or something like that. So it's really important. It's really hard to do business on a markup basis. Always do it on a profit margin basis. So I'll show you how to do this in a minute. Whatever profit percentage you want to make, divide it by your sales price, and it'll tell you where to mark, where to set your profit, or where to set the price of your product. So hopefully that makes a little bit more sense. All right, break even. Break even is the point at which your revenue exceeds your expenses, right? That's pretty straightforward, right? Now I can show you a graph that makes it a little more complicated, but here's how I like to use this. So let's say as a business owner, I'm going to start here. Let's say as a business owner, you're trying to figure out if you should invest $100 in marketing. Okay, let me check. I'm going to check my percentage down here, 85%. So let's say that you're in a coaching business or consulting business, and you want to see if it makes sense to invest $100 in marketing. Well, if your gross profit, meaning after you pay for your overhead, is 85%, and I'll show you what that looks like when we get to the income statement, then the way that you figure out your break-even point is you take whatever your cost is or your investment and divide it by your margin. And that's going to tell you what your sales need to be to pay for that expense. So here's what an example looks like. So let's say you'd like to invest $300 in marketing. Your average gross profit is 85%. Just take the dollars you want to invest, divide it by your gross margin, and it'll tell you what your sales need to be in order to break even on that expense. Does that make sense? Now, if you don't know where to get gross margin, I'll go through this in more detail later. But on an income statement, you have income here. Your gross margin is right here, your gross profit. So you're taking your income and any cost of goods that you might have for resale. Sometimes you'll have like commission for sales reps, sometimes go into the top line. So in this case, this company's gross margin would be 82%. You don't factor in all these fixed expenses down here because they're going to be there whether you make this new investment or not. So you just go to your income statement and you say, my income is this, and your income statement will come like this. It will tell you if you use Xero or QuickBooks or Wave, and you request your income statement, it will show you a report like this, and it'll tell you, well, there's your gross margin or there's your gross profit. So in this other example, you're just going to take whatever amount you'd like to invest, and you're going to divide it by that percentage from your income statement. It'll tell you what type of revenue you have to get out of it in order to make that decision make sense. Does that make sense? So what I'm trying to do here is not explain all the beans about bean counting, but share why this matters, because this is how we need to make decisions as business owners. Now, this is a very conservative approach, because another argument could be made, well, why not divide my expense by my profit margin to figure out if I can afford it? That's another way to do it, but this is the more conservative. This will show you the least amount of sales that you need to recoup your investment. So anyway, hopefully that gives you a little bit of an introduction. Does that make sense? Okay. This is just a fancy graph. I want to explain this real simple and note a couple things. So notice what's going on here in this red line. Fixed expenses are what? They're fixed. They're going to be there, and that's the definition of a fixed expense. A fixed expense happens whether you have any sales or not. The blue line is revenue. Look where we are in the beginning of a business, right? Now, while they're not business expenses, you've got your personal expenses, and that's one thing. But a fixed expense might be the cost of your website. You might have a cost of your domain name, or you might have a mailbox if you don't have an office, or you might have an office. You might have a cell bill that you've got to have because that's how customers get a hold of you. So your fixed expenses, you're going to have some fixed expenses in the beginning of a business. And this revenue line is sales. And see, we've got to have sales for a while before we even get to our break even, right? Before we cover our fixed expenses. But then as we have fixed expenses and as we have sales, we also typically have an increase in variable expenses. Now, let me think about this for a second. So, Adrian, with your business, if you're not employing anybody full-time, you wouldn't have a whole lot of variable expenses unless you're buying the decorations and things that are going to go there and then reselling them. Right. So you won't have a whole lot of variable expenses. Right. So yes. The fewer number of employees you have, see, it depends on your type of business. Paul, if you're doing appliance repair, you may not have any variable expenses unless you're buying a switch or something like that. So in smaller businesses that are very us intensive, we're doing the business, we go from fixed expense to profit real quick. And one thing I don't like about this, but quite frankly, I'm not sophisticated enough with Excel to fix it yet. What really happens to this line, this net profit line down here that's green, is right here at the break-even point, which is where our revenue hits the total of our fixed expenses here. Take your fixed expenses and your variable expenses, it equals this yellow line. Once our revenue covers that, our break-even point, this green line starts to bend up at a fast rate. It shoots to the moon. Does that make sense? So your average profit dollar before break-even is 0. But after break-even, your fixed expenses are covered. And your profit percentages go from 1% to 10% to 30% to 50% until you start adding employees and other fixed expenses. Does that make sense?
Is that on an annual basis?
Let me think. I'm not sure I understand your question.
So I guess it's just I'm because the fixed expense, when you say 500,000, right?
Yes.
Is that a monthly fixed expense?
That's a great question. Yeah. Monthly would be a smarter way to evaluate it. And there's nothing magic about a month. It's just how we happen to measure our business results.
Right.
So yes. So as a business owner, you want to be hyper focused on, are you breaking even on a monthly basis? Because remember, that's our number one job, is to sell enough business so that we are covering our fixed expenses, and then the variable expenses are the expenses we encounter when we have a sale. So if I have a sale and I have to buy something to execute that sale, then that's a variable expense. It comes whenever I have a sale. And as soon as our sales get above our fixed expense and that variable expense, if your employees are 100% commission, that can be a variable expense. We'd like it to be. So the other thing, though, is smart business owners think about break even per week.
Say that again. Smart.
Per week. So don't wait till the end of the month, but am I breaking even this week? Right? So that takes a little time. But in the beginning, we're trying to get launched and really make a profit on a monthly basis. Does that make sense?
So I have a quick thought that just occurred to me, and I don't know if it's, hopefully it doesn't muddy the waters, but sometimes you can talk about your taxes, like you have to work until whatever, May 17th in order to pay your taxes for the year. If you're working a regular job and let's say you're on salary and you know about what your tax percentage is going to be, then I can say, okay, I have to work till, like, one way of evaluating what you're paying in taxes is how long you have to work into the year before you've actually made the amount of money that you're going to have to pay for taxes over the whole year. And then anything after that is, you know what I'm saying?
I know exactly what I'm going to go back and add that, because that's something I talk about, but I want to put BEP by day, week, and month. So
the break even kind of calculation is sort of like, seems like it's along that kind of a thought process.
It is. So what you want to do, again, y'all are in startup phase right now, but as you get further along, you want to know what day of the month. So what he's talking about is tax freedom day. And, tax freedom day used to be like, I don't know, April 3rd. And then it moved to April 15th. And now it's like June 1st or something. So our tax rates have gone higher and higher and higher. So theoretically, we don't make any money in our jobs until like July or something of each year. Same thing with your business. You want to know what day you hit your break-even revenue. So if your break-even revenue is $10,000 in a month, you want to know what day of the, you want to, instead of hitting break-even on the 30th day of the month, you want to see if next month you can hit break-even by the 29th day, and the next month by the 28th day, and the next month. Now, when you have higher overhead and employees, you want to break that down to by week. What day of the week did you break even? Did you break even on, did you have break even sales by Wednesday, or did it take Friday at 5 o'clock? And then once you get that figured out to where you're breaking even on Tuesday or Wednesday, and the rest of the week you're just working for next week, then you want to start thinking about break even point per day. So did I hit my break even point for my daily sales break even point? Did it happen at 10 a.m. or did we have to, did it take till 5? Now, a little bit of this is more applicable to like retail, walk-in service type businesses, but it's very applicable. And the sharper and bigger your business is, the more you want to, like Paul said, you want to ratchet it down by month and to week, and then eventually to day. Are you breaking even on a daily basis? And you as a business owner, did you bring in the bacon? Did your team bring in the bacon on a daily basis? It's going to be needed to hit the break-even point. So here's a question. Cash is a fact, profit is a theory. What does that mean?
Cash is something you can spend.
One way to look at it.
Hope for.
What was that?
Profit is something that you want to see happen, but it hasn't happened yet.
That's exactly right. You are going to need cash in a business no matter what. It's a fact. But profit, you may spend a whole lot of cash before you ever reach a profit. Some businesses never reach a profit. A lot of businesses never become profitable. So cash is a fact, profit is a theory. And what we have to really do is make sure that we measure, that we're really careful with our cash. Now, this is a little complex. I'm going to make it real simple. What happens in many businesses is we have stock or we have expenses that we have to put out. It could even be for our website, for our rent, for our cell phone, what have you. So we're putting out these expenses, in the beginning of the month for our business. And then oftentimes, if we're in a stock business, we're holding that stock. It might take 60, 90, 120 days to sell that stock that we purchased at the beginning of the month. And then if you add on top of that, okay, now we've got to collect for the sales that we made. Sometimes you can be buying stock or making investments in your business here in the first 30 days. It might be 120 days before you get that money back. And that's called the cash gap. And lack of enough cash flow is what kills a whole bunch of businesses. And that's where I really recommend that businesses have a really strong cash flow forecast. And I'll show you what that means here shortly. I'm not going to get into these strategies. It's a checklist for you for later, because it would eat up all of our remaining time. And that's by design. But these are strategies that you can use to keep yourself out of that. The strategy that we're going to talk the most about will be your cash flow forecast. So here's what an income statement is, right? A basic income statement just has these elements. And I'll put this back over here. It has sales, variable cost, equals gross profit. And that's, remember this, sales. Cost of goods is considered a variable cost. So see, we're being consistent here. And then less your fixed expenses or overhead, which are these areas below the expense. And then we have our net profit. That's really what you need to know. Print this slide out, keep it somewhere handy. And then your questions are more about, okay, what's a fixed and what's a variable expense? Here are just some examples. Here's the thing. Remember this. Expenses that occur whether you have any sales or not are fixed expenses. So when you break out your income statement, put them down here. Okay? Because you're going to have these expenses whether you have sales or not.
Mhm.
Variable expenses happen because you have sales, okay? Increased hourly labor above the norm, materials, things that you're reselling, performance-based commissions, freight, etc. So again, good sheet just to print out, real basic stuff. And I've already shown you this guy, this dude several times. But it's just what we said. Income is on the top. It says here square income. This customer just had the little square device, and that's one of the methods that they collected payments from customers. I could have easily gotten rid of that line item. Again, under total income, you have then your cost, you take away your cost of goods or your variable expenses. That leaves you with your gross profit. And then you've got all these expenses below. The reason I have these yellows on here, what I like to do, and I've blacked this out, is I like to create income statements that show multiple months side by side by side. And all of the software programs that I mentioned, especially QuickBooks. QuickBooks is the easiest to do this in. The rest of them, you got to get a little creative. But you want to always be looking at more than one month at a time. And software programs treat you like there's just 1 month at a time. Oh, everything looks great. I guess I don't need to look any deeper. And that is such a disservice. You always want to be looking line by line item, month over month, multiple months at a time, so that you can see things like, oh, wait a minute, my cost of goods were 17% in September, but they went up to 30% in October. What's going on there? Did I have, okay, I had bigger expenses for goods. Did that even out over the next few months? Oh, I was getting ready for Christmas. Okay. And I had to stock up my inventory a little bit. My purchases weren't quite as big in November. And then in December, it fell down because now I'm trying to get rid of inventory that I bought, right? So you want to look at your biggest line items on your income statement. And in this case, it's cost of goods, it's rent, it's payroll. And you really want to watch those. You see on a percentage basis, year to date, those are my biggest numbers. These are the game changers for you. And this is how I look at an income statement. I look at the biggest number, 27%, and I say, what's that number been doing over time? Well, it was 4,000, 4,000, 4,000, 8,000. What? Oh, okay. I decided to prepay my rent so I could, because I had a good year and I wanted to decrease my tax liability. Okay, no problem there. I'm good with that. And then payroll. You know, my payroll was 17.9, 17.4. I probably could have given a better example here because in all likelihood, your payroll would skyrocket in December if that's your busy month. This is a retail business, by the way. It's a DIY type business. So a better example really would have been to bump that up a little bit. Anyway, hopefully you get the idea. I need to make a note of something. So advertising and marketing was a little low here, but you can advertise high for the Christmas season. And you just go line item by line item and look at, I like to look at 12-month averages. So you can just do a little work in Excel here. I like to look at 6-month averages, and then I like to look at the last 3 or 4 months. Does that make sense? Just kind of logically start with the big numbers, look for anomalies in dollars or percentages, and then dig deep, figure out why. Does that make sense? All right. So far, if this seems altogether, I'm making this relatively simple, raise your hand. If I'm not making it simple, you can give me this. Making it simple? Okay. All right. All right, good. Important numbers to track. You know, again, revenue, profits, projected cash flow, which we're going to do in a minute. Key performance indicators. You want to track lead generation, average dollars per sale, average number of visits per year or transactions per year per customer. Just do this stuff in Excel, okay? Acquisition cost to customers, wages as a percent of sales as you get bigger. Now, your income statement will show you some of these, but sometimes you got to do the same thing in Excel, and these are called key performance indicators, and they're things that you want to track. And This is just called a dashboard or a key performance indicator tracker. And this is just an example of things you might want to track. Set it up in Excel, put days and weeks above it. And you can go straight into our days, weeks, months ahead of it. I'm sorry, days, weeks, or months at the top. And you just, cost compare your numbers across the top.
I think we might have lost the other Adrian and
It looks like we might have.
yeah,
Oh,
I noticed they were both frozen in my frame, and then they just disappeared.
interesting.
Yeah, just in the
I'll
last.
keep a watch. Yeah, I'll
10
keep a
seconds.
watch and see if they pop back up.
Oh,
Hey, there
there's
they are.
Adrian.
Hello. What happened? Sorry, I didn't bounce you off on purpose. Sorry about that. Well, I'm glad to have you back.
Glad to be
So what we want to do here kind of in the home stretch is talk a little bit about budgeting and, income statements and budgets. Really, I talked about fixed expenses and variable again, so I'm not going to dive into it again, but I want to talk a little bit about how to use it. Building annual forecasts are really important. I'm not going to go through all these line items. I want to show you a why or a how. So cash flow is really important. That example that I just showed you about the income statement, right? It looked a little bit like this, only with a lot more numbers, right? So these are the guts of it. Now they're different numbers. A cash flow statement is really just everything below net profit. Okay, so forget about equity inflow and cash position. If we just looked at these numbers right here, it's just your income statement. So Paul, this is answering your question. So if I did nothing new in January, I would have a net profit of $5,000 and cash flow of $5,000. Now this is if you're using the cash based accounting for profit and loss statement. So in January, I increased my cash by $5,000. So I'd take $5,000 and I'm good. I go to February and I lost money. So if I didn't put any money into the business, I'd still be up $3,750 because I made $5,000 profit last month, right? So take 5,000 minus that 1,250 and I'm still $3,750 to the positive. But then March, we'd have to dig into why. It looks like low sales. March was a really rough month. Guess when is a really bad time to go to the bank? March. You go to the bank in March, they're not lenders. Lenders aren't in the risk business. They're in the risk aversion business. So if you know that you're going to have seasonality in your business, take your historic numbers out of Excel, out of QuickBooks, and just drop your average numbers into Excel and look at what your profit was and see what happened to your cash along the way. So this will start to help you see, if you know you're going to have a rough month in March, hey, I better be figuring out in January how I'm going to cover expenses in March. And this is where a lot of business owners get in trouble, is they don't realize that it's going to take 12 to 18 months, sometimes more, sometimes less, to build their business. And you want to proactively forecast what you think is reasonable so that you know how much cash you're going to have to get your business to break even. Now, obviously, the quicker you can get your sales up, probably the fewer months that you're going to lose money. But hopefully this gives you some idea of what cash flow looks like. It's just figuring out in advance when you think you're going to need more money and then having a plan for it. Is it your 401k? Is it a credit card, which isn't usually a good idea? Is it cash? Is it an SBA loan? Most business owners don't think about 6, 9, 12, 18 months down the road, and they get a month or two from being out of money and they have that oh no moment, right? So your businesses aren't going to have that happen though, because you're going to be great marketers. Any questions on that? And one thing I want to emphasize is it is possible to have great profit but no cash because you're investing in the business or you're not collecting fast enough. And it's also possible to have no profit but still have cash if you've got money set aside or funds that you can pull from. And then I've talked about this. If you're setting up budgets, there's great resources online, YouTube. Just do a YouTube search. YouTube is the second most popular search engine next to Google. So there's a wealth of information. Realize there's some people on there that don't know what they're talking about, but generally speaking, you can find some good resources. And I talked about this a little bit already, the cash flow forecast. Let's see. Let's talk about balance sheet a little bit and why balance sheet is important. So in many ways, at the end of the day, once your business starts making money, this is really your report card. Okay. It isn't just the profit you make, but down here, what's the owner's equity? And a balance sheet by definition is the assets of the business here on the left minus the liabilities of the business, which is this little piece up here. And that tells you what your business is worth. So if you have, in this case, $37,000 of assets and you owe, it could be accounts payable. It could be a note payable. Maybe you borrowed $5,000 from a friend to start your business and your total liabilities are $30,000, then you're upside down a little bit right now, right? Or you actually, in this case, you'd be positive $7,800. So does that make sense? And again, I'm just trying to make this real simple. So all that a balance sheet does, which is very important, is it tells you, do you have a positive net worth or a negative net worth? Now, why is this important? Because as we grow our business, we want this number to get bigger. We want to build a machine that's building equity so that we have, I'll show you what some assets are. Assets are equal to the liabilities and the net worth. They just balance out that way. But what does an asset mean? Well, I'll start with liabilities actually. So liabilities can be accounts payable. They're just different things that you owe people now. That would be your current liabilities. Long-term liabilities would be intermediate, bank loans, things that you're going to pay back over time that aren't due in the next 30, 60, 90 days. And then, like I said, this is how the game works. Net worth is the assets of the business minus its liabilities. So we just have to be careful not to get our long-term debt and our current liabilities too high too fast. And then assets have current assets as well. They can be accounts receivable. If you prepay some expenses, that's considered an asset. Cash is an asset. Whereas fixed assets are things that you have no matter what you have in your business. So it could be furniture that you bought for your business. It could be equipment that you've bought for your business and things like that. There's other assets that are more intangible, like patents and things like that, but they're not really applicable for most businesses. And then, what are the uses for balance sheet? Well, we want to know what's our net worth and what are the debt levels. I look at net worth on a monthly basis and assets and liabilities to see if my debt's going up or down with my clients. Is cash going up or down? Are accounts payable or accounts receivable going up or down? Because sometimes your balance sheet will look good because you build out a whole lot of stuff, but you're not doing anything to collect it. Does that make sense? You've got this big asset. Oh, I got plenty of money. But if you're not actually calling to collect or billing people right away, you can be creating a problem in your business and run out of cash. So these are just some simple ways that people use the balance sheet, but it is important. It's just not a whole lot of people use it the way that it should be. So I've got some other things I'm going to share with you, but what questions, any questions? That was a real high level view. Anything that I didn't get into that you'd like me to address now or on a breakout?
Mike, I have a question.
Mm-hmm.
So when you're putting your own cash into a startup business instead of getting a loan from a bank or a friend or whomever, so on your budget sheet or your cash
Right.
your balance sheet, that's something that you also have to track as well, right? As a
Right.
personal loan that you put in the business. And
Right.
is that something that you have to budget to pay yourself back, I guess, from the business?
You do, and that's a great question to get technical details from an accountant, not a bookkeeper. But essentially, what you have to do is you have to be careful not to pierce the corporate veil, is what it's called,
Right.
and mix transactions between personal and business.
Mhm.
So if you put money into your business, you literally have to sign a loan agreement. You have to agree to a loan payment schedule.
Mhm.
Now, and then you should honor the schedule. Now, here's the reality. As the business owner, you can tear that thing up and redo the agreement anytime you want. But yes, there should be an entry on your balance sheet that's called something like owner's contribution,
Mhm.
and that would be on the asset side. And then you have a corresponding entry under liabilities, and it could be note payable to owner. So that would be a great example of a note payable. And you do want to have that document exist. I don't know that I've ever heard of anybody being raked over the coals because the document wasn't clear enough.
Mhm.
But you do want to have it. You do want to pay yourself interest, make it something reasonable, 5% or something like that. When I've done things like that, and I've done like 10-year loans, and I've got to make the first payment by the end of the first year, and it's going to be this amount, and then the second payment, and like a balloon in the 5th year, so that I don't have to worry about making payments to myself.
Right.
That's just how I've chosen to do it. And then obviously, if your business grows really fast, you can just write a check and pay that thing off. And you want to keep that and record it, have a digital copy of it that can't be lost.
Okay. And is that
Great
something
question.
that you should have a lawyer actually draft up, or is that
Nah,
you can do as a business owner?
I honestly, I Google it. I
Okay.
mean, like, so I would Google two things. One, I would just Google loan repayment agreement and see what that looks like. And you might even Google to see if there's probably somebody out there who's written a document that a business owner can use
Mhm.
for owner contribution to a business.
Mhm.
And you can probably pay $25 and download it.
Okay.
If you pay an attorney to do, I mean, if you're talking about investing $100 or $200 or $300,000 in your business, yes, get an attorney.
Okay.
Because that's a big dollar amount. And, when you start getting into big numbers like that, the IRS might start to care
Okay.
because it can look like you're padding income. It could trigger an audit.
Mhm.
So I would let my accountant tell me whether they thought I needed a legal agreement from an attorney, but most of the time, just a simple agreement template is going to be enough. Again, I want to qualify that with, ask your accountant if
Okay.
your loan amount is enough that you might want to talk to an attorney about it.
Okay. And is it better if you're putting your own money into your business, is it better to do it as a loan or as, I guess, an investor?
That gets a little bit into legal entity, which is a better question for a CPA.
Okay.
But generally, if you're just are you a single member LLC?
Yes.
Probably not an investor because you're the owner.
The owner.
So
Okay.
I've not thought about that before, but I don't think you can be an investor in yourself.
Okay.
Logically, I'd say no. So it would just be owner's contribution. That's one word that is called owner's contribution to equity, owner's contribution or loan. Those are just some different ways to do it.
Okay. All right. Thank you.
Any other questions? No, glad you asked. Great question. So what were a couple of top takeaways? Anything that you hadn't thought about that maybe this had a light bulb go off for you? A blinding flash of the obvious. How about you, Paul or Adrian? What was a takeaway for you today? So I know what's valuable and what I can spend more time on next time around.
My honest answer is I'm going to hire an accountant as soon as possible.
Yeah.
Then I did my job. Yeah. I mean, seriously, it's one of the top 2 or 3 ways that business owners mess up.
Yeah.
Now, don't go out and hire a Charlotte or Columbia most valuable CPA. I once did that. I don't know what the heck I was thinking. I wanted the best of the best. The dude was costing me like $1,000 a quarter, and I have a degree in finance. I didn't need that. So I came to my senses, and you know, you want to have somebody who has a good reputation. Best case scenario is ask them to tell you how are they a tax accountant or are they a more of a financial accountant? And generally speaking, you don't necessarily get both. Sometimes you have to have 2. So your tax accountant you might talk to twice a year, but your bookkeeping / accountant, you're probably talking to them quarterly. And as you get bigger, you'll definitely want to do monthly. If you can find one that does both and they can prove it to you, great. And it could be anywhere from $50 an hour to $200 an hour, just depending on where you live and who you find.
I
And
would
check their credentials.
I would say the 12 killers, that list of 12 things that kill a business, Adrian and Teresa, I would really say that I personally, because I meet with small to mid-sized business owners multiple times every week, and all of those things are things that I've seen business owners do, and like our I do digital marketing, and our basic local search plan is $300 a month. And whenever I have a business who's up and running and they're doing a lot of stuff and they say they can't afford $300 a month, I cringe, because it's like, my God, how close are you to closing your doors? And in the 2 years I've been doing this, there's been 4 businesses that I've met with, and one that I just recently saw, that I look at their business, I look at what they're doing, I look, just knowing intuitively the kinds of bills they must have, and then they say they can't afford $300 a month to be found on the internet, which is kind of critical.
Yeah.
And I just know they're going to be out of business. And one of them, I was just over here 2 days ago and went to work out, and this business that I had met with had shut their doors. And I'm 4 out of 4 on businesses that I said that place is not going to make it more than 6 months or a year. One place was a liquor store that spent $10,000 on their counter, and he couldn't afford $300 a month to be found on Google.
Wait, on a counter? Like,
And he's gone. He's gone within a year. I'd go in, he's there 6 days a week, working 12 hours a day by himself because he can't pay anybody. So that list of 12 things, when you were going through that list, Mike, I can't tell you how many business owners I've met that have made so many of those mistakes, including myself when I had my own small business. I made huge mistakes in putting too much money out in equipment and everything else. And so that's one of those things where to me, it's like a no-brainer to hire an accountant. It's no-brainer to hire a business coach. People that have seen this, they've been down this road before. They know what the pitfalls are. And if you don't listen to them, you're really taking your chances. So those are, I would just tell you, just from the number of business owners that I see on a monthly basis that are struggling, it's because of those kinds of things.
Yeah.
Thanks, Paul. Good advice. Really.
And it only takes one of them sometimes.
Right. Well, that's what I'm saying. That guy that spent $10,000. The only reason I knew he spent $10,000 on that counter is because I read an article that he gave to, or an interview he gave to a realtor who did a a write-up on him in her
Yeah.
newsletter. And I said, tell me about this, it's, you know, it's I can't even remember what you call it, but
Yeah.
I said, tell me that he ordered, you know, custom made. It was the least noticeable thing in his place.
Yeah.
And anyway, so
You probably gotta be. I want to be sensitive of everybody's time. That's.
I'm sorry. Yeah, I
No,
apologize.
that's okay. What about?
It's just I hate seeing people do that.
I know. Yeah, you and me both. What about you, Adrian and Teresa? What was your takeaway from today? Anything that made you think?
For me, I would say the same thing Paul touched on is running out really quick to get a CPA and QuickBooks.
Yeah.
Yeah.
Good.
Yeah.
I've done my job. Yay.
Yeah.
The other thing too is, like Paul said, here's the thing. If we don't have enough cash to invest in marketing our business, and we don't have a business where we can just go out and physically walk people into our cash register, we don't have any business going in business because we don't have the cash flow to sustain it. So kind of to Paul's point, anything you would like to add, Teresa? Anything that you got that was helpful or really spoke to you?
Yes. And I think Paul mentioned this, and Paul, I need your information too for future reference. But going out right away and getting more than what you need for your business at this stage, you know, because that's one of the things that I'm thinking. Okay, I was talking to Adrian earlier, and we need this, we need this, we need this, I need this, I need that. And at this stage, I have to make my business official first. Let's just get a name, let's get it official. You know, maybe at this stage, you don't need all of that right now, but you just want to run out and get all these different things you can think of that you will need. But at
Right.
this stage, it's not necessary. So I would end up spending more than what I need to at this point. So I thought that was that made me want to pump my brakes and just reevaluate some things.
You said that better than I did. That is such a huge point. The thing that we have to do, and you've heard this in your personal life, there's a huge difference between wants and needs. And needs are things that you ask yourself this question: must I absolutely positively have this
Right.
to profitably grow my business at the rate that I need to be successful? Must I absolutely positively have this now to grow my business and be as profitable as I need to as soon as I need to?
Mm-hmm.
And if the answer is no, put it on an Excel spreadsheet called a parking lot and park it and tell yourself what you have to do to earn the want to. You're not in, we're not in want to stage at the beginning. We're in have to.
Mm-hmm.
And if you do the things, you've heard this too, if you invest your money on things that you have to have, you'll be able to invest your money on things you want to have later. Channel a little Dave Ramsey. So great point. And really question yourself on things that you think you need. Talk to other business owners. Get some people's advice, because we're real good at telling ourselves, well, I need that. I need that to feel this. I need that to feel that. Well, okay. How are you going to feel about a $10,000 or $12,000 countertop when you're out of business?
Right.
I'm glad it felt good then, because you're going to feel really cruddy when you have to close the thing and go back and get a job.
And that's the thing I was going to touch on. It feels really good to buy new stuff.
Mm-hmm.
Yeah.
Right. If it feels good, you're like, oh, you justify it in your mind. It's not going to break down on me. It's not going to whatever. But and Teresa, to your point, when you said you wanted my information, my first reaction to that is talk to Mike. If he feels like, it's the time to talk to me, then yeah, let's talk. I mean, I'd be happy to talk to you anyway, period. But, it's one of those things where it's, talk to not just other business owners, because not all business owners out there know what they're doing either. Talk to a business coach, talk to people who've seen businesses succeed and fail and know what it takes to do both, and get their advice. That's what I would say.
Yeah. Good qualification, because there's good doctors and doctors who aren't so great. And there are business owners who know what they're talking about, and business owners who will run you right into a ditch. And coaches too. So next, this one's going to be fun, because it's about leadership and building accountability, leverage and systems, and kind of a capstone discussion. But this isn't leadership just of others, it's leadership of self. And it's building accountability with ourselves. If you don't have a coach or you don't have other people that you're leading, we got to do this for ourselves because it still needs to happen. So we're going to talk about some tools and things along that line. And it's really a fun. I've got a personal list that I've built that's kind of like that business killers. It's about different keys to leadership, and you will have either done each of these items or experienced each of these items, good or bad. And I think what you'll be able to see is how it applies to all of us, really at any stage of our business. So I think that's about it as far as what we had for today. The date and the time, we're coming up on the last one. Also, what I'll do at the end is there's some other options, other things that I do. I've got, for different stages of different businesses, I have different things going on. Starting in January, it'll probably be late January, we're going to have what's called, it's actually called Profit Club, but it's really peer management, peer leadership, and peer brainstorming. And that'll be once a week. I think we're going to do it on Tuesday mornings. And it's a business owner accountability, goals, and it's lightning round stuff. So we'll be going around the horn, share your biggest win, share your biggest challenge. What do you want to get done by the next time we all get together? We get together 3 times a month. And then there's also an option if somebody wants to have ongoing accountability with me, just in a small slice. And what it does is it helps somebody go from action club, and they're not really ready for one-to-one coaching, on a weekly basis or something like that. But it gets you involved in like Paul said, talking to other business owners, hearing best ideas. The type of people that get attracted to this are people who are going to succeed. It's just true. So, like I said, it's called Profit Club. I'm probably going to rename it, but it's really business owner peer groups is what it is. And that'll kick off in January. And I'll talk a little bit about that. But any questions anybody has before we call it a day? We went a little bit over, but
oh, sorry.
No,
I was wondering, do we go to the bottom of the hour or quarter to the hour? I couldn't remember.
What time did we get started?
Oh, quarter after, whatever it was.
Yeah, that's right. So we started at 12:15. So normally we would end up at 1:30. So I appreciate you indulging us for going a little bit over. But last time that I did this, I did an hour and a half, and then I did another hour. So we did really well to really, get this down to the basics. And if there's anything you think of that you think that we could have, would have, should have, could have covered, let me know, and we can figure out how to handle it.
I want to say one other thing to Adrian and Teresa. This morning in our BNI group, Mike and I are in a BNI group together. Holly Simpson, who you might remember, was on the first couple of these calls with us. Apparently has brought Mike on as a coach, and she gave a testimony this morning about Mike that after bringing him on and him working with them on some of their systems, they had their best month ever. And she was just so thankful that she made that decision to do that. So she's not here because she's working more intimately with Mike now. So that's why I say, somebody like Mike, and I'm not here to sell Action Coach, obviously. I sell digital marketing.
I don't pay him much.
He doesn't pay me, but that I've talked to enough business owners to know that in my mind, if you don't have a business coach, it's kind of like, thinking you're going to make the Olympic team without having a coach to tell you, to run a certain way, or maybe your feet are placing in the wrong, you know what I'm saying? Yeah. So anyway, you guys are doing the right thing being in something like this. I hope to see you on December 16th and other things too. And would love to talk to both of you individually about marketing and answer your questions with no obligations or anything at all. I'm the last thing from a high pressure sales guy you'll ever meet. So probably to my detriment, but.
Thanks, Paul. I appreciate it.
Yeah.
Thank you.
Yep. Well, I will look forward to catching up with everybody here in a couple of weeks. And with regard to coaching, don't when it comes to coaching, especially, don't get preoccupied with cost, whether it's with me or somebody else, because most of the time there are options that fit any budget.
Okay.
It's like Paul said, just find something that works for you, whether it's me or somebody else. And with that, we'll go ahead and sign off and put this one in the books.
Okay.
And,
I don't see you guys. Have a Merry Christmas.
Yep.
All right. Same to you.
Merry Christmas.
all right.
And can you, if you don't mind, can you send the slide again? For some reason, I couldn't open it. I
Oh,
don't
the
know if anyone
slideshow,
else can open it. You're right.
the slideshow.
Right. Can you please do that?
Yeah,
If you don't
absolutely.
mind? I don't know. Maybe it was just me. Operator error again.
Should have come across. Do you have PDF downloaded on your desktop?
I do. I do.
Interesting.
I'll try it again. I'll try it again.
If it doesn't work, shoot me a note and I'll resend it to you. It should work.
Sometimes you have to update the software from time to time. Sometimes that causes a glitch, but
Okay.
and sometimes if you don't reboot your computer every day, do that.
Okay. That could be the problem.
Have a happy holiday and we'll see you soon.
Happy holiday.
All right, bye now.